Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And don't forget it.
Welcome to another edition of Talk Money. Our goal here on the show is to help improve your money IQ. Thanks for tuning in. For those of you who may be visiting us for the first time, let me introduce myself. My name is Jeffrey Shank. I'm a chartered financial consultant and owner of Andover Advisory Group, a registered investment advisor, which was founded in 1996 with one goal in mind, and that is to provide objective financial advice. We invite you to participate in the show. If you have a question, you can send an email to jeff@talkmoneyradio.com, or you can call the toll-free number at the top of the screen, or you can simply post your question right on the Facebook page, or if you want to send a private message, something in particular that you don't want to share with the rest of the world, feel free to do that as well, right through the private messaging feature on Facebook. And also, I want to mention that we are available after the show, again, simply by calling the toll-free number. So if you find something that we're talking about here is of interest and you want to get to know more about it, or you'd like to meet with us personally to discuss your individual situation, maybe you're having an issue with your with income taxes, or maybe you're getting ready to retire and you're trying to figure out exactly how to get through that. We are here to help with all aspects of your personal finances. And Lou, good morning. How are you?
Good morning. I'm doing well. Good Monday morning.
And I just wanted to let the whole world know that we are running just a couple minutes late this morning, and it's not your fault.
Okay, great. I appreciate that. Very well, easily could have been, but no, not this time. Yep, we've run into some audio issues here. I can't hear you at this point. You haven't muted yourself. I'll mute you and unmute you. No. All right, we've got some audio issues here. Not sure what's going on. So, yeah, you muted there or plugged in? Yeah.
Quite possibly.
There you go. You got it back.
Let me reiterate.
What did I say?
It was not your fault.
Yeah, well.
It was not your fault. Apparently, this headset has a little mute button on it.
That may be the two for August that aren't my fault.
And as I said, I'm just getting used to this. So
yeah,
I don't know how much you heard, but I was saying that I wanted to test the remote capabilities, and just to see how it works, see if it makes sense, see if it's easier than trucking down to the studio.
Are you anticipating another shutdown?
No. So I guess I'm curious, Lou, because COVID changed the world. It changed the way we do business. It changed the way we interact. And there's a lot of controversy about the reopening and getting back to work, and who should go back to work, and Should you be vaccinated? Can you go back to work if you're not vaccinated? What should you do when you get there? Do companies have the authority or the ability, let's put it that way, to mandate that their workers get vaccinated? And so I was just curious about, or I'm getting curious about how that's all going to work out, and whether or not more and more individuals are going to be working remotely. Is this change in the way we interact more permanent? Or we're going to try to get back to the way things used to be? My guess is the former, not the latter. And I have a feeling that a lot of these changes have been made permanent.
Yeah, because
in many respects,
people are finding the financial benefits of it, and I think people, adapted to what was happening during COVID, and so they're going to take some of the best parts of that, some of the ability for people to work remotely. That has helped some companies in some certain ways. So I think they're going to take it. They're going to cherry pick the things that worked, that were positive, and try to keep those. There was the story today about the Boston gym that's going to start checking for vaccinations to allow you to take your mask off during there. And we've talked about this the other way, all the way around. Private companies get to do, I think, what they want to do. If you want to work there and they want you to be vaccinated, that's your choice whether to work there or not. And same thing with patronizing a business. If you like their rules, you patronize them. If you don't like their rules, you don't, I guess.
I would be in that camp. That would be my sentiments. Mm-hmm. However, if you are a business in Florida, that's not necessarily true.
Right.
Because the governor apparently has issued orders that restrict businesses from mandating that their employees be vaccinated. So I don't have an opinion one way or the other. I think it's really up to the individual businesses and how they feel. And as you said, the consumer and customers. How do customers feel about it? Do they want to patronize your business if you're not taking precautions? Maybe not, or maybe they would rather you didn't. So I think that's what it really boils down to, is personal choice. But listen, we got a good show lined up today, Lou. First of all, we talked last week about initial public offerings, IPOs. That's where a company starts trading in the public markets for the first time. We went into that, and I've got a follow-up to that show. And this is the first week of August, and I wanted to kind of recap what happened in the markets for the month of July. And we have today's Talk Money tip. Today's Talk Money tip is all about reverse splits.
Reverse splits.
Reverse splits. Yeah. That actually happened today, and I thought that would be an interesting topic, because it can cause you a lot of emotion, an emotional roller coaster, so to speak. If you don't understand what they're all about and how they work. So we'll do that in the third segment. But let's just talk about IPOs again. Okay. And just to summarize, an IPO is where a company that has been doing business and is owned privately by individual investors, or in some cases mutual funds or venture capital funds. That's where they seek capital in the public markets by trading their stock on an exchange. And so what happens leading up to that particular day is a whole lot of legal and regulatory compliance, and a lot of decisions about what the company should be worth and how much investor interest there might be in the stock at a particular price. And it all culminates on the day that stock starts trading publicly. Mm-hmm. And there's a lot of misinformation about that. And one of the key takeaways from last week's show is that if you're buying the stock on the day that it starts trading, the first minute that it is available to the public on that exchange, You're not getting the IPO price.
Right.
The IPO price is only available to insiders, initial investors, friends of friends, brokerage firms that are participating in the IPO, and they're, in many cases, their best customers. Those are the people that get access to the IPO price. And so the allure of an IPO is that once it does start trading publicly, that the hope is anyway.
Mhm.
And in many cases, and generally speaking, what happens is the price pops.
Yeah.
And so you, as someone who's getting the IPO price, can make a very quick profit when it does start trading, because you can see that that demand for the stock start to go up, and you can potentially make a nice see a nice increase in the value of your investment if you're buying in at the IPO price. But like I said, most people don't have access to
Right.
to IPOs. And what I said last week was that in a lot of cases, and if you look at the chart of a lot of IPOs, a lot of new issues, you'll see that there's a spike in the spike up in the price, and then it starts to moderate a little bit. And in a lot of times, the price actually trades lower than the IPO price.
Sure.
So just because you missed out on the IPO price doesn't mean that you can't buy that stock at, near, or below the price that it initially was offered to the public. And so I got a couple of examples of that just in the last couple of weeks, Lou.
Yeah. Okay.
The first one is a company that was an early investor in the company was an actor named Mark Wahlberg.
Heard of him?
Yep.
Yep.
And the name of the company is F45 Training, I think is the
Oh, yeah.
is the name of the company. And so this is a physical trainer. It's actually live, and I guess some streaming training sessions, right? Very, very structured. You get a personal trainer. It's a franchise model, and there are because they started the business and they've been growing the business before they actually went public. There are locations across the country, and so the company started trading publicly a week ago last Thursday.
Mm-hmm.
So a week and a half ago,
mm-hmm.
on a Thursday. Okay, so they priced the shares at $16. So if you were one of those insiders, you were able to get the stock at $16.
Oh, okay, that was the insider.
That was the right, exactly.
Mhm.
Yeah. And the price did pop to over $17.
Okay, that's hip hop.
That's one headline I saw.
Yeah.
Yeah.
Okay. Wow.
Yeah. So it didn't double, and it did go up, like many do. But there was a lot of negative. I actually was reading about it before it went public, and there was a lot of negative headlines or negative analysis. Let's put it that way. Negative analysis on the stock.
Yeah.
Saying that this is the type of business, because of COVID and just because of the numbers of the company, that it looked like it was not going to be a good, a terrific investment longer term anyway.
Right.
And in one story it said you might want to just if you have access to it, you might want to let this one go by.
Yeah. And
not make an investment at all. And so last Friday's close on this stock, Lou.
Okay.
$15.22.
Wow.
So if you missed out on the IPO and you really like the business model and you like the idea that Mark Wahlberg is involved in this company,
Gee, who can take on that kind of volatility?
you can buy the stock now below what it started trading at when it first went public. Now, I'm not making. I just want to mention I'm not making any recommendations here or saying anything about the company or its prospects or its business model. But it does have the company does have its challenges for a lot of reasons. And I guess the one positive in this particular company is the presence of Mark Wahlberg.
Yeah.
And, it's a project that he's involved in, and I'm sure that he is a type of person who likes to succeed.
Sure.
And his endorsement, I guess, is something that the company can count on as long as he's interested in maintaining a relationship with the business.
Yeah.
And I don't know. I'm not sure how you feel about live training sessions or personal training sessions.
No.
But there's a lot of competition for
Yeah.
that as well.
Yeah, I mean, we don't need another gym, I don't think. There's a certain group of people who would enjoy the live training, but first of all, there's a lot of online quote unquote live training, and secondly,
Right.
most people like to train on their own. I think.
I think it's a niche. Given the I did a little bit of research on it, and I took a look at the business itself and the type of structure of the training, and I think this is for people who are how do I say it, more athletic, I guess.
Yeah.
Very, very. These are physically fit people who are looking to maintain or improve their physical fitness. I think that's the client that they're attracting.
Yeah.
Again,
it's not the Planet Fitness model, but they're up against Planet Fitness.
Yeah, but
Yeah.
Woody, I don't know if you've ever joined or been involved in Planet Fitness. I mean, it's up to you, right?
Yeah.
Planet Fitness.
Yeah, it's not their clientele. Planet Fitness people just trying to get in shape. You're talking about athletes who are trying to get even more elite.
Yeah, I think so.
Yeah.
Yeah, I mean, that was the impression I got. I could be totally wrong.
Yep.
Yeah. So
people who buy IPOs, though, generally speaking, are looking for that pop, right? And in this case, they didn't get the pop. They didn't get the quick profits. But by the same token, the stock didn't crash on them either. So, they didn't make money, but they didn't lose money.
By the way, Lou, I don't have the numbers, but we're seeing record issuance in new issues, IPOs.
Oh, I'd imagine. Yeah.
Yeah. And don't know exactly why that is, other than it appears that there is, at least for now, an investor appetite for risk, and that would be a reason why these companies are. And I get the impression that a lot of companies are accelerating the process and coming to market a little bit earlier than maybe they thought that they might, to try to take advantage of that interest, that investor interest.
The market is high, and I'm guessing a lot of people feel kind of flush and like, what do I do with this?
Yeah, that could be a good reason too. And the government just keeps putting money in people's pockets, and that might be another question people are asking. So what do I do with this? And
it's Marky Mark, so why not invest?
Right. So another company that went public last week, Lou. So the F-45, a lot of people probably didn't hear too much about it, but one that had a lot of publicity was a company called Robinhood.
Yeah.
So Robinhood, for those of you who don't know,
had a big year.
Yeah. So Robinhood, for those of you who don't know, and I was actually quite surprised how quickly this actually happened, is a online brokerage firm that offers brokerage services, trading services to the retail investor, and it's mostly through a mobile app. That's what they do, and all your trades, as far as I know, all your trades are free. By the way, there's no such thing as a free lunch. So
right.
If your trades are free, you have to wonder how they're making their money. And by the way, how they're making their money is what they call pay for order flow, which we're not going to get into today. But there's a lot of controversy over that. And so Robinhood went public, and they actually offered their shares to their customers, and they have like 22 million accounts, and so they offered all of their account holders the opportunity to get in at the IPO price. And so here's what happened.
Let me ask you a question about that, because we can go to F45, whatever the company was, before, and Robinhood. How many shares are usually issued in an IPO? And I'm sure it's not usual. I'm sure it's all over the map, but
it is.
But Robinhood offering, they have 22 million customers. How many shares did they attempt to sell?
So I don't know the exact numbers, but I think it was in the hundreds of millions.
Oh, okay. Yeah. Wow.
Yeah.
Wow. I mean, imagine. Yeah.
Yeah. And so it's really the numbers of shares are really immaterial. What's important is the price per share and the total number of shares that are outstanding. So issued and outstanding are not necessarily the same thing. And so the company still retains, in many cases when they do an IPO, they don't sell all their shares. They still retain some of the shares. So they're only selling a portion.
A minority, I would imagine, right?
Typically. But then there are other investors who are able to, as part of the offering, offer their shares, because that's the initial investors. They want to try to make some profit here, so they're allowed to also offer as part of the IPO the shares that they hold, right? And so the important thing here is to multiply the IPO price, the share price that's being offered, times the total number of shares that are actually issued, and that puts a value on the company, and that's the key. When you look at an IPO, what is this company valued at after they go public and sell these portion of the overall shares outstanding? So. They priced it, Lou, at $38 a share.
Mm-hmm.
And I watched this one very closely.
Did they sell fractional shares of their own share?
That's a great question.
That's part of their business model, is offering fractional shares.
Fractional shares.
Yeah.
That's a great question. And I don't know the answer for sure, but I do know some individuals who made an investment, and they did not buy fractional shares.
Yep.
So not sure exactly how that works, but that's a great question, and one we'll follow up with.
Yeah.
So $38 a share was the price that they came up with.
Mm-hmm.
And I watched this one very closely because I was really interested in the company, the business model, the investor interest, and just to see what was going to happen here. They did get some negative stories leading up to the IPO, including some regulatory issues that people thought, well, depending on who you're talking to, could have been a problem, or maybe not such a big problem. But anyway, they continued the process, went public, and Lou. Immediately, the price fell below its initial offering price.
Oh God, yeah.
And closed last Friday at $35.15.
Wow.
Now
it's an interesting situation all around, because it's a through the looking glass type of situation that these people are offering shares and then offering shares themselves in the businesses brokering shares. But also, the people who would invest in it, the investors they were looking for, aren't the people who use Robinhood, I wouldn't think. I mean, I know they offered it to their customers and expected a return from that standpoint, but they were looking for bigger fish.
Oh, absolutely.
Yeah.
And they were able to land those bigger fish. There's no question about it. But typically, what happens, and this happened with Facebook years ago, typically what happens is if there's this big this company that comes to market for the first time, it gets a lot of publicity. There's a lot of fanfare leading up to it, and what happens is people start to get a little greedy, and they overprice the shares. And I think that's what happened in this case. That same thing happened years ago with Facebook. But with Facebook, what we saw happen was that the brokerages that were, and the financial firms that were involved in the IPO, they went into the market to support it, because what they wanted to see was, at the very least, a close at or above the initial offering price, because then they look kind of silly that they overpriced it, right?
Yep.
In this particular case, that may have been happening, but it
wasn't effective.
It wasn't effective
at
all. And it just started. It started trading lower and just kept going lower, and it finally came back up towards the end of the day, but is still selling at less than its original price of $38 a share. So why do I say all this? Partly because this happened. This coincidentally occurred after we had talked about IPOs, and one of the things I had mentioned is that don't feel left out. Don't feel as though you've missed out on an opportunity,
right?
Just because you're not getting the IPO price, and be very hesitant about buying the stock on the first day that it starts trading, because you could end up paying a lot more for it than you could have, even though you're not involved in the IPO, even though you couldn't get the IPO price. And that's exactly what happened in these two instances. And by the way, these are not the only two companies that went public. I didn't look at all of them. I have no idea which companies actually did better on their first day of trading. So don't take this as a reason to not get involved in an IPO, or don't misinterpret what I'm saying here, that all IPOs fail, and that you can usually buy in at a lower price. That's not necessarily the case. So
what I'm hearing is, in these cases, in these two companies at least, they priced the shares relatively accurately. And for there to be a major profit where you would, quote unquote, miss out, where the price would immediately go significantly higher and stay there, that would require a miss by these brokerage firms putting out the shares, wouldn't it?
That's a lot of times what happens if it really pops. Then you look at the management of the company itself, and you look at the financial firms that were involved in it, and you say, geez, did they leave some money on the table? Because, by the way, all this money that, except for those shares that are being sold by existing shareholders, right? Most of the shares are being sold by the company, and all this money is going to go into the company's coffers.
Right.
And so you're right. If it ends up popping, they missed out on an opportunity. Of course, if it falls below the IPO price, they got some extra money that maybe they didn't deserve to get, or that maybe didn't really represent the value of the company.
Yeah.
And so you said something that got me thinking.
The fact that in these two companies' cases, it looked like the pricing was fairly accurate. I mean, we're talking a small margin one way or the other.
Thank you. I would say that in this particular case, maybe they overpriced it.
Yeah,
I think they overpriced it. That's my personal opinion. So I'd have to disagree with you there. I think they overpriced it. But that's good for the company. The company made out, because obviously, at least the investing public didn't think it was worth what it was being sold for.
And it's funny, if pricing it a little bit short might have created some of that frenzy that would have, eventually evolved into quote unquote pop.
Right. So who would have benefited from that would have been
brokers,
brokers and other new investors in the company would not have benefited the company.
Right.
Would not have benefited the company, because although it could have resulted in more investor interest in the company, and maybe longer term could benefit the company, but at least initially not. Yep. So I just wanted to follow up on our IPO discussion and give a couple of real life examples, and keep in mind that we're having record issuance. I don't think that's going to go away anytime soon. And so if this is something that you'd like to incorporate into your portfolio, you think it's something that you'd like to talk about and see how you can benefit from investing in new companies, either before or after they they go public, please give us a call. Use the toll-free number, 877-475-2062. Send me an email, jeff@talkmoneyradio.com, or you can just send us a message on right on the Facebook page. So we're gonna take a look at what happened in the markets in July, Lou. Just to kind of recap where we're at, and I got a couple of comments about where we might be headed in the near future here. So we're going to take a break, but we'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back to Talk Money. So oh, there it is. Okay. So I'm sorry. I'm just getting used to this stuff here. No, I can't see you. Oh, there it is. Okay.
Okay. Yeah.
Yeah, it's so the window was a little bit small here and I can't see you. So if you cued me, I had no clue.
No, I didn't. No.
I apologize.
The cue is when you see yourself, just start talking.
Oh, okay. All right. Hey, so I was talking to an attorney with one of the many law offices here on the third floor at the Riverwalk, and I haven't seen him in a long time. COVID kept him at home. He's older, and he told me that he's just coming back to clean out his desk because he's retiring. Really? Yeah. So not COVID related. It's time. Yeah. It's time. And so he was, so I haven't seen him in a while. And so he said, so, geez, what's going on in the markets? And he got me thinking about it a bit. And I said, and again, because I haven't seen him in so long, I was thinking about it not just in terms of what happened yesterday or last week or last month. I was thinking about what has happened since I haven't talked to him. Which is pretty much the entire length of the pandemic. And so he said that no. So I said, I said in many ways, surprising. What's going on in the markets, given what has happened. I said, given where the economy is and where it was and still is. I said, the fact that the economy, the country was shut down and businesses were effectively out of business, at least for a period of time. Most businesses, anyway. Yeah. That it was kind of surprising that in such a short period of time the market had recovered and hit new heights. And I said, even given where we are, economically speaking, right now, kind of surprising that it continues to do what it does. And so you have to wonder if there's another shoe to fall at some point. And so I just wanted to kind of just recap what's happened so far this year, what happened in the month of July. The S&P 500, that's an index of the biggest, or 500 of the biggest companies in the U.S. stock market, is on a 6-month winning streak.
Yeah.
Yeah. Doing better than the Sox.
Lately, yeah.
Lately. And year to date is up 17% so far this year, and that would be considered a really, really good year.
Pretty healthy, yeah.
Yes. And here, I guess here's the concern that I have is that for a lot of people, especially some that are new to the markets, these kinds of returns, they might think that this is the norm.
Right.
And let me tell you, that is not the case. As you can see here, the Dow is up. Oh, by the way, Lou, I didn't even ask you to show that slide, and I just brought it up, and there it was. So thank you.
What I find interesting about this is, of the indexes, the 3 indexes we normally follow, the NASDAQ, which did well during the pandemic, is the trailer of these.
Correct.
Yeah.
Yeah. So there seems to be a rotation out of those pandemic, those companies that were benefiting from the pandemic. A lot of technology companies, the virtual reality businesses,
Yep.
the Zooms, the WebEx of the world, and a lot of other companies that could rely on technology that actually helped to make life bearable for people during the pandemic.
Right.
A rotation out of that to the more traditional types of businesses that are benefiting from the recovery period of the pandemic. And those are the companies that you'll find more of inside the S&P 500, and of course the Dow Industrials. And by the way, this is just a change in overall price of these indexes, and doesn't include dividends that might be paid on the companies that are included in the index. So overall returns could be better than this if you are investing in those particular stocks, or if you're investing in an index fund. The overall performance of your investment could be a bit better, anywhere from 2 to 3%, depending on which index you're looking at. And so the month of July, we were up 1.25 on the Dow, 2.25 on the S&P 500. Although we did have a bad week last week in the markets, kind of volatile, big sell-off on Monday, and then things came back,
Right.
and then on Friday, a little bit of weakness. We ended the week with a little bit of weakness, and so it still had a strong month, and it just keeps happening. And you have to ask yourself, you have to wonder, how long can that continue? Can trees grow to the sky? Generally, no. They can't. And so, at some point in time, we're probably going to see some sort of a correction. Could be a major correction, and you want to be positioned properly to defend against that. And the key to this is diversification, making sure that you're just not invested completely in equities, or you're overweighted in, let's say, technology companies. You want to be diversified is the bottom line. And the other thing that I think is very important to note is what's happening with the price of oil. Remember, during the pandemic, Lou, I don't know, it was short-lived. It was absolutely astonishing, but based on futures prices of crude oil, people were, this was not actually happening, but the price suggested that people were actually paying you to take the oil off their hands.
Yeah.
That was what the futures prices were suggesting, because they went negative.
Yep.
They actually went negative, something I had never seen before. I'm not a futures trader. Understand how it works. We use it as a way to follow what's going on in the various markets, including oil.
Yeah.
But I had never seen anything like it, and even the experts were perplexed. And so it has come back strongly to the point where we're at prices that levels that we were at before COVID hit, and a number that is can allow oil companies, producers, to actually make some money.
Yeah.
And that's what's happening. So that'd be something I think that you need to take a look at. And if you're looking at your portfolio and wondering where you might be able to diversify and invest, well, commodities, specifically energy-related companies, might be an opportunity. And there's a little bit of a lag. The price goes up, and companies start to make profits. They don't make profits immediately, so there might still be an opportunity, even though the prices come back substantially. It might be an opportunity there to make some investments.
Now, I have to ask this question because the administration and those speak for them say that the administration has nothing to do with energy prices, which would suggest that policy doesn't have anything to do with energy prices. So you have to wonder what has caused this rise in the last year, what caused us to get to that point that you talked about during the pandemic when prices were low. And I know capitalism suggests that the answer is supply and demand, or at least demand, right?
Correct.
So has
supply...
demand rebounded to the point? Has demand rebounded that much that it would cause this type of increase?
Well, of course it has. And it's not just the demand. See, I'm not an expert in the oil markets. Yeah. But there has been a substantial increase in demand just because economies around the world are getting back online.
Yeah.
Right. But what happened during the pandemic was that supplies were reduced.
Yeah.
They had to be.
Right.
Because, as I said before, according to the futures prices, the producers would have to pay you to get rid of their oil. That's what the
producers shut down for a while because
they had to.
Yeah.
Because
the market wasn't favorable to them.
Right. So a lot of oil rigs went offline. A lot of companies went out of business, and the supply was reduced naturally through supply and demand forces. However, there was a time when the Trump administration actually effectively joined the oil cartel and requested that they reduce production, which they said, yes, we will.
American companies or
no.
International, the international.
Well, no, U.S. companies are not part of the oil cartel. We're talking about Middle East producers as well as Russia.
Mm-hmm.
Yeah, that's what we're talking about when we talk about the oil cartel. Yeah, and so
was this at the point where prices were so low that American companies were saying, "I'm not producing oil because I can't make a profit at it"?
Correct. Right. Yeah. Right. And the Trump administration asked the oil cartel to reduce production in order to support prices effectively.
Yeah.
Without actually joining the cartel and manipulating the price of oil. And so their production went down. The supply and demand forces in the U.S. forced a lot of producers to shut down, and it's taking a while for them to get back up. And of course, in the cartel itself, they can't agree on anything, and so they're having difficulty figuring out what their production levels should be. And so it's taken a while for it to all come back. And so that demand came back quickly. The supply has not. The price jumped. That's the bottom line. Yeah. And here's the other thing that I think is really critical. I think it's very important, and it's something that I think we need to keep an eye on, Lou. And that is what's happening in the bond market. So we started out the year less than 1%, and on the 10-year, right?
Yep.
And again, a lot of that had to do with the intervention by the Federal Reserve. The economies around the world were slowing down, so it would make sense that yields on fixed income investments on bonds would fall, right? But we figured once things got back to normal, yields would go back up, and they did for a period of time early this year. All of a sudden, just in the last couple of months, we're seeing that yield come back down again. And it has economists, investors, policymakers scratching their head, wondering what the heck is going on, because this yield was close to 2% at one point
Right.
this year, and everybody expected it to continue to go over that and rise towards the 3% level, just because of what was happening with the reopening.
Right.
For some reason, we're at 1.222, I think, as of this morning. So I think that is it's a yellow signal.
It's a canary in the coal mine.
Potentially a canary in a coal mine.
Yeah.
What it's saying is that a lot of money is being invested in the bond market for some reason, and who knows? Maybe it's people who don't know what they're doing. But generally speaking, when you're dealing with the bond market, they're very sophisticated investors. Now, a lot of it has to do with the Federal Reserve and their intervention, but still, this is a very curious number, and one that suggests a slowing in the economy. And so I think we have to be conscious of that and continue to follow that.
Well, where's the money coming from? Because people are buying more bonds. They're not taking it out of the market. The market's doing fine.
Good point.
Yeah, usually it's a transfer from one asset class to another, right?
Yeah, some of it might have come out of cryptocurrency.
Oh, interesting.
But I don't think so. I don't think the people that are investing in cryptocurrency would invest in the bond market. So that is a great question, Lou.
Yeah.
I don't know the answer, but I just think it's worth. I'm not saying that. Or the possibility of stimulus. I don't know.
Yeah.
But you would think that if we're concerned about inflation, if inflation is on the horizon, that you would see this yield going up, not down. So perhaps it was the concern about inflation that caused the yield to go up, and perhaps that has subsided to some degree, and so the yield is starting to come back down. But it's just
when the Fed calmed us on inflation, people took that to heart, and it kind of backed off their bond buy.
Yeah, maybe, or it could be it could actually be a defensive play.
Yeah.
So again, worth noting, worth following, and something that we'll keep an eye on. Hey, so if you want to take a look at your overall investment portfolio, make sure that it's properly diversified. We can make that part of our no obligation initial consultation. Please give us a call. Use the toll-free number or send me an email, jeff@talkmoneyradio.com. We'd be glad to sit down with you. There is no cost. And I'm sure that you'll have some actionable information after we have that meeting. It happens all the time. Hey, so I've got this week's Talk Money tip, Lou. And this week's Talk Money tip is about reverse splits. Now, you know what a split is, right? When a company splits?
Yeah.
Like 2 for 1?
Yeah, basically, I know I have a very simplistic handle on it, so I'll be interested in this. Yeah,
so the opposite of a split is a reverse.
Oh.
Reverse split. So I want to talk to you about that when we're going to take a break, but we'll be right back. So please stay tuned.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. So, Lou,
Yeah, you're okay.
okay, all right. I heard the music. I didn't know if I was
Fading it under.
yeah.
But I
Hey,
can-
so a note comes up that says the host has unmuted you.
yes.
So that would be a good cue too, right? I can use
Yeah, you
that.
can- yeah.
All right. Okay.
I usually do that a little early because there's like 4 things to do before we get back.
Oh, okay. All
Yeah.
right. Well, it did that, and then I saw my image, and so I figured it was time to talk.
Yep.
So, all right, fine. We're working on
When
the
you see
details.
yourself, yeah, when you see yourself, you can start talking.
Yeah. A couple of weeks we'll have this done. It'll look professional, I'm sure. Hey, so
Wait a second.
what?
It already looks professional.
It'll look like we know what we're doing. Hey, so
Like that.
I know. I'm sorry.
Yeah.
I know what I'm doing, Lou.
Okay.
So stock split,
Yeah.
right? So I had this situation where it doesn't happen often, but I actually had this mutual fund that did a 2-for-1 stock split,
Okay.
right?
That's usually a good thing, right, for shareholders.
Well, see, so what happens when a company does a stock split? It's usually because the price of the stock is getting to a point where they feel as though it's a barrier to entry for smaller investors, and for a lot of other reasons, they think that we really should do something with the share price, and so they do a stock split. Let's say a 2-for-1. Typically, that's what you hear. That's what you see, 2-for-1, and so. What that does to the value of the company, the value of the stock, is absolutely nothing. All it means is that you have 2 shares for every 1 share. And what happens in the market is there's an immediate price adjustment. So the stock that was selling for $1,000 a share, after the 2-for-1 stock split, you have 2 shares at $500 each.
Okay.
And so it really does nothing for your investment. A lot of people like it because they get additional shares. They like to see that those new shares in their account. And studies have shown that typically that means that the company is growing, and they're usually what happens is, and it doesn't happen all the time, but in many cases the value continues to grow. It's usually a good sign. Let's put it that way. Usually it's
But
a good
you don't
sign.
profit more because you have twice as much.
Not immediately. Not
Yeah.
immediately.
Yeah.
No, does nothing to the value of the stock. Does nothing to the value of the company. It's just a change in how many shares are outstanding, and the price is adjusted accordingly. Right.
It's denomination. You have 2 5s instead of a 10.
Right. And so what happens is you see this kind of immediate effect on your account in real time when you're dealing with a stock. But a mutual fund only prices once a day, and so I had this situation where this mutual fund did a 2-for-1 stock split on a Friday, and the price changed, but the client didn't see, or investors, anybody who owned the fund, didn't see an increase in the number of shares immediately in their account. And so if anybody, and I got like several phone calls.
Yeah.
I had no idea it was happening, and it looked like the price dropped in half.
Right. Yeah.
And in fact, it was reflected in their account as such. So the value of their account when they opened it up, surprise!
Really?
Oh
Yeah.
yes,
Yeah.
yes. No warning by the mutual fund company, basically, that this might happen. No warning by the financial institutions that held the accounts that, hey, be aware of this. And so I had to send out a broadcast message to my clients and say, hey, in case you own this, don't worry, it'll all work itself out. You'll be fine. So, but on occasion, Lou, companies do what they call a reverse stock split.
Okay.
And it's just the opposite of a 2-for-1. So instead of a company that was selling at 1,000, issuing 2 shares to each shareholder for every one that they had, and now the price gets adjusted to 500 per share, just the opposite happens. And let's say it's a 1-for-2, stock split.
Right.
So what ends up happening is now that company that was selling for $500 a share gives you 1 share for every 2 that you held. And now the price goes to 1,000 from 500.
Okay.
So typically this happens when company's stock price has fallen dramatically. There's a possibility that the share price could limit the ability of their stock to remain on an exchange.
Okay. Yeah.
It could restrict certain institutions or investors from buying it, or certain firms from allowing their brokers to offer it. And so they do a reverse stock split. Well, that happened today with GE.
Oh, really?
Yes. They did a 1-for-8.
Wow.
Stock split.
Wow.
So I just want anybody who's following GE stock, if you note that the price jumped 8-fold, it's not because they reported good financial results.
Don't go buy that Maserati.
It's because they did a reverse stock split today.
Feels like there's a lot of status involved in this. I mean, GE obviously off the Dow for a year ago.
Yes.
Year or so ago, yeah.
Yes.
Yeah. So having a low stock price would be a problem for a company like GE.
Yeah, and I'm sure that had something to do with, maybe not the only reason why they did it, but it becomes a problem because they're taking back 8 shares for and giving you 1 for every 8 shares that you own.
Yeah.
So if you only owned 7 shares, guess what? They don't round up.
No.
They pay you cash.
Oh, really?
Yeah. You don't get a full share. So they just
cash you out?
They just cash you out.
Wow.
Yeah. And so for every odd amount that you have, so if you had 32 shares, you get 4, right? If you had 31 shares, you get 3 in cash.
Yep.
Yeah. So that could be happening in your account. It gets a little complex. But I wanted anybody who's following GE stock to note that they didn't.
Woo woo.
Yeah. Hold your curb your enthusiasm.
Yeah, really.
Yeah. So
so this was no notice too, just happened this morning?
No. Of course there's notice. No. There's notice. This was all in the works. There's all kinds of notifications that they have to make, but the average investor is not looking at those notifications.
Sure.
Didn't know that this was going to happen, and they're just going to open up their app that they're following GE price, the price of GE stock, right? So they open up their app, and it went from 15 to 100.
Hopefully they haven't told off their boss this morning.
Yeah, wait on that.
Yeah, wait on that.
Wait on that. Yeah. All right. So, that's this week's Talk Money tip. These kinds of things happen, and it's important not to panic when they do.
Yep.
And that's something that a professional can help you with and keep you focused on what's important. And that's the kind of work that we do. So again, if you want to get in touch with me after the show, please use the toll-free number 877-475-2062. Send me an email, jeff@talkmoneyradio.com, or just send us a message right on the Facebook page. We do offer an initial no obligation consultation. I think, as you've put it, Lou, it's not a sales pitch. It's really,
it's not an orientation. It's talk about a specific issue that you have, and hopefully get some useful information that you can go forward with, and just try out the relationships, see how it works for everybody.
And I would say that now more than ever, it's probably a good idea to be taking stock of your investment portfolio, no pun intended, and get a good read. Get a good read on the risk in your portfolio and what might happen if we do have that correction that is sure to come.
And consider reallocation and making sure that your allocation is within the boundaries it should be with all these changes in the last year or so.
Exactly.
Yep.
Correct. So I guess that's all the time that we have today. We'll be back here next week, same time. And
maybe a couple minutes earlier, actually.
Maybe a couple minutes. I'm sorry. Yes. Thank you.
Yeah.
A couple minutes earlier, a little more polished, I'd say.
We'll be fine.
We'll be good.
Yeah.
So we'll see you next week. Please join us then. And remember, in the meantime, good sound advice is much better than advice that just sounds good. Thanks, Lou.